Hello everyone, and welcome to your Glassnode video update for week 38, 2022. So this week we are going to be covering the Ethereum Merge. We're going to be looking at what really is a feat of engineering in the blockchain space, a truly remarkable development and something that should be really congratulated and celebrated considering the scale of it and how many years this has been underway. So what we're going to explore today is some of these new proof of stake metrics. We're going to understand how they actually operate, how it describes consensus, what the validator distribution looks like, and we're going to look at the reality of the supply dynamics. There's been a lot of talk about Ethereum going deflationary, and we're going to actually look at the data and say what has happened since the merge. So as I mentioned, this was a successful deployment of a long-standing engineering project. This has essentially been a transition that's been underway for Ethereum for many, many years, and that is the switch from proof of work to proof of stake. So what we now have are two very large projects, Bitcoin being proof of work and really one of the last ones standing at any kind of meaningful scale, and Ethereum, which has now switched over to proof of stake, which really provides us an alternative option in terms of these different on-chain metrics and just exploring and understanding how these two different systems work. So we're going to explore these new on-chain metrics related to proof of stake because there are a lot of differences. It does operate in a very different manner and it does have very different properties to proof of work. We're going to look at the movement of validators in and out of the consensus pool, as well as some of the nuance relating to what that means in terms of issuance, because issuance actually goes up when you have more validators coming in and vice versa. We're going to look at the current ETH stake supply and the distribution of stakers, looking at how much of it is actually held on certain staking providers versus solo staking. And then we're going to look at the realities of the deflationary supply dynamics. There's a lot of talk about EIP 1559 and the effect that the burn will have, whereas what we've seen over recent weeks has not quite aligned with that deflationary reality that many were expecting. So we'll look at some of those realities and I'll present a series of models that we've launched in Workbench that can actually help you track the real factual performance of this network and the supply dynamics. So as always, please do give us a rate and a share and a subscribe. Hopefully you enjoy this particular content where we are going to be doing a deep dive on the merge and understanding a bit more about Ethereum proof of stake. So the first chart that I wanted to start off with is actually an interesting one, really just to show how dramatic and different the reality is between proof of work and proof of stake. Now remember that there are these two different mechanisms are entirely different systems. What they are doing is keeping the consensus of the blockchain. But what you can see here is that this is the mean and the median block time. So with a proof of work system, it's far more probabilistic. We essentially have miners who are attempting to solve a puzzle. The target block time, which for Bitcoin is 10 minutes and for Ethereum was 13 seconds, that's essentially demonstrating where the average time should be. And the difficulty adjustment winds up and down the puzzle according to the actual observed block time. So on the left-hand side, we can see this natural variability. This is the time, the randomized time in some sense, around that target interval of miners actually finding blocks. So you can see that we get up here around 16 seconds. It gets down here as low as 8 seconds. You can see it's quite variable. This is the probabilistic nature of proof of work. Now, once we transition, you can see where the merge happened. This merge, essentially, that's immediate swap over. Difficulty instantaneously went to 0. There was no difficulty wind down. Essentially, all proof of work blocks stopped, and we transitioned onto proof of stake. Now, the difference with proof of stake is that it uses a system called slots and epochs, and we'll talk about this in a bit more detail, but essentially the slots are pre-programmed. They will come every 12 seconds, so it's more of a defined interval. There's not really that random probability. There's not the competitive nature, so to speak. The protocol selects a validator and says, here is a slot, would you like to fill it with a block? Now, for the most part, they generally do, and we'll explore those parameters later on. But you can see the difference between what is closer to a commodity style mining operation that we see in proof of work versus essentially a system where the slots are pre-allocated and a validator is selected to propose a block within that system. So two very, very different models, two very, very different consensus mechanisms, and you can see the transition clear as day in this chart. Now we're going to run through two dashboards today, and these are both now within our Ethereum preset. So you'll see proof of stake consensus where we'll start. This is looking at all of the raw consensus parameters and the behavior types. And then we'll go to the post-merge supply dynamics to actually understand what is going on with the burn, the deflation, the inflation, and what is the reality of that situation. So starting with proof of stake consensus. You'll see in this text box here, I won't go through all of these points, but it essentially outlines what a slot is, what an epoch is, and the intervals that these come in. So generally speaking, slots are essentially pre-allocated. There's a series of slots that are going to come in, and each time a slot comes in, there's about 128 validators who are selected in a committee to actually essentially manage that particular epoch. So an epoch is 32 slots, and 128 validators are selected to look after that epoch. So for each slot, one of those validators is opted to actually build the block. So the slot, think about that as an opportunity to build a block. Sometimes they miss it. If a validator is offline or unreachable for any reason, you'll have a missed block. So this missed block here is essentially a slot that was offered, but the validator didn't respond. So we have the slot height, we have the number of missed blocks. Occasionally we get moments in time. You can see that after an upgrade that happened somewhere in late 2021, we've essentially had very, very few orphaned blocks. An orphan block is essentially two blocks that will produce at the same time by two different validators, but only one of them can be selected as the chain tip. So it's essentially a block that was produced, but was rejected by the network, kind of a history that could have been that didn't happen. So then we have the epoch height, which is then how many times we had those 32 groupings of slots. And for each of those epochs, we'll have a new committee of validators. You can see there's quite a lot more going on in the proof of stake system, and we'll touch through this as we go, but there is a lot more dynamic, a lot more moving pieces than proof of work, which is generally speaking a relatively simple consensus mechanism with a problem that needs to be solved by miners in order to find that next block. So it's a little bit more complicated and nuanced in terms of how it works. There's a lot more pre-programmed systems like committee of validators and pre-selected algorithmic choices and slot heights. So it is slightly different. There are more moving pieces, but we'll step through it one by one. So when we move on to look at things like network stability, as we saw above, these missed blocks, these are essentially slots that did not get filled with a block. For whatever reason, the validator was offline or simply didn't respond. So if we look at how many blocks were actually filled versus how many slots were offered, we get the participation rate. And you can see that we typically oscillate between 98 to 99%. For the most part, we've been in the 99% realm. So this is basically saying that more than 99% of all blocks were filled, or all slots were filled with a block, and we had very, very few missed blocks. So a lower value on participation rate essentially means that we may be getting some set of validators, maybe a large staking provider is having issues with their node, perhaps a client was having a bug. There's been a few of these instances where we saw these drop-offs, although we really have stayed above 97% for pretty much the entirety of the beacon chain's existence. So really we see these in a very short-term events. But if we ever do see participation rate drop significantly, it may signify a client bug or a large staking provider is having issues. Now, I mentioned before that there's 128 validators that essentially work on each epoch. One of them proposes the block and the other 27 attest to it. And they say, yes, this follows all the consensus rules. So if we multiply that out, we have an epoch is about 6.4 minutes. Over the course of a day, if all 127 of those validators are voting yes on that chain tip, we should get somewhere between about 800 and 700,000 attestation votes every single day. And we can see that this is essentially where the network has stabilized, up in the 700 to 800,000 realm. Alongside this drop in participation rate, we also saw a brief drop in attestations. So again, this gives us a bit of indication that perhaps there was some form of bug across one of the clients or a staking provider that was of a reasonable enough scale that it had a noticeable impact. But overall, we have seen both of these metrics recover back into their expected ranges. So far, network stability seems to be fine. But you can see that we can use these two to really assess how many validators are actually online and responsive in the participation rate, and then look at the attestation count to see how many of those validators are actually saying, yes, this is the correct chain tip, and I'm voting to approve this particular block. Now, when we talk about validators moving in and out of the proof of stake consensus, there is in fact a queue. You can't have too many validators coming in at once, and you also can't have too many leaving. There is an entry and an exit queue. And this is really to keep the overall network stable. When you have too many validators trying to come in, it's essentially a door that can only fit so many in per epoch. So that's what this chart here is showing. You can see here in red, this is our active validators, which you can see has been more or less up and to the right through most of the beacon chain's history. This blue curve at the top here is essentially the imposed cap. You can see it here, the churn limit. It's a maximum of 4 per epoch, but it does increase the more active validators are on the network. So essentially, the more validators that are online, the more are allowed to come through the door. And you can see that there's periods of time where we get these large bursts of new validators. This chart down here is the actual number of new validators. You can see that these align very closely. You get lots of validators trying to enter the protocol. We essentially hit the queue cap, and it has to take some time to actually process all of those entrants. You see that active validators climbs at the same time. And then you see there's other periods where there's marginally fewer. We don't quite hit the cap. There's all of this white space. It's essentially showing that we have far fewer validators trying to come on board. And thus our gradient here, the number of active validators, slows down a bit. So this is essentially looking at the queue of validators trying to come in, and this chart down here is plotting out the actual number of new validators who are entering the network. And we also have those that are exiting the queue. Now, this is a fairly small number. We're talking about less than 500 have been slashed, less than 500 have voluntarily exited. We're talking about a relatively small number of validators who have left the space. Now, remember that when a validator actually leaves, whether by voluntarily or by slashing, at the moment, they still can't withdraw. They're waiting for the Shanghai fork to actually do withdrawals of the ETH. So at the moment, the ETH stays there, but you can exit your validator from the pool. So it no longer participates in consensus. There's no reward, but there's also no more penalties. Now, as for what these slashing events are, it remains to be seen whether these were actually devs testing to see whether the slashing mechanism works, whether it was just some kind of malicious behavior, whether it was some kind of client bug. It would require a bit more further detail to understand that, but we have only seen to date 175 slashing events, and only 677 validators have opted to leave the network. So really, it's been more or less inflows only for the most part. So now we're going to look at a little bit of a nuanced topic, which is called total staked balance versus effective staked balance. Now, when every validator enters the queue, they must deposit at least 32 ETH. Now, from that point in time, they may earn some revenue from issuance and fees. They also may have an inactivity leak, which will cause their balance to go down, and they also may be slashed. So there's a few ways that their balance can go up and down from that 32 ETH. That's kind of the starting point, and it will deviate from there. So the total amount staked includes all of those deposits plus all of the revenue minus any of the slashing and inactivity penalties. That's the total amount that has been deposited. However, each validator can only have what's called an effective balance that is capped at 32 ETH. And it goes down in 1 ETH increments. So if they have 31.5, for example, that means they have an effective balance of 31. There's a few more details here. I'll leave you to read through the actual specifics. But in general, the effective balance, think about this as the actual total ETH stake that's participating in consensus. Because each validator can't have more than 32 that's active, any revenue that's earned on top of that, think about it like a buffer. If they had a little bit of an activity leak, their effective balance would stay at 32. So it's trying to keep the network nice and stable in terms of the amount of stake that is actually there. So if we look at these in combination, the red curve here is our total balance. And you can see that over time, as revenue is earned, the green balance underneath it, which is the effective balance, which is that it's actually participating in consensus, starts to deviate. This is essentially capturing the revenue and all of the delta that goes beyond that initial 32 ETH staked. So you can see it does start to climb higher. And then this purple curve is showing the percentage of how much is effective versus the total. And where we are at the moment is down here at about 94.6%, which means about 5.4% is sitting there as bonus revenue, essentially a buffer over and above the amount that is actually actively participating. Now, moving on to our last two charts for this section, we're looking at the total ETH staked by service providers. Now, we've continued to profile here at Glassnode quite a number. We've added a number of different staking providers. And where we currently are by looking at all of the staking providers that we're currently looking at, there's just over 10 million ETH, and it represents about 69% of the total stake. So what that essentially means is that the total stake is captured by the 69% of all staked ETH is hosted on these providers that we've got tracked here. And we can see Lido down the bottom here in green is the largest, at about 31% of all stake. We then have Binance, Kraken, and Coinbase. And between these top three, we're talking about 59% of the total stake. So a very, very large amount. And there's a lot of reasons why people would do this. We see that there's a technical overhead to running a validator. There's convenience and just delegation of risk. There's those investors who just simply have less than 32 ETH and need some kind of pooling solution. And there's also the ability to tokenize stake. And we're seeing this in Lido, we're seeing it in Rocket Pool, and we're also seeing it recently in Coinbase, where they released their CB ETH product, which is essentially a liquid staking derivative of Coinbase staked ETH. So there's a lot of reasons why we're seeing this behavior. It's one of these things that's been talked about for a long time, but now we're actually seeing the full numbers that we're talking about. 69% of the stake is hosted on those staking providers. Some of them are more decentralized than others. There is a bit of a spread there, but there are logical reasons as to why customers are choosing to use these products rather than stake on their own. And the last chart that we're going to look at is the staked realized price. Now, what we're looking at here, this again really shows you why a lot of people move towards Lido and these liquid staking derivative tokens. This red curve here shows the average price of all staked deposits. And the average price of all staking is about $2,340, which is obviously quite a bit lower than where we currently are, trading down here about $1,300. So this yellow curve here is showing the amount of unrealized loss, essentially how much have investors deposited, and by holding that staked ETH based on the price when they deposited, essentially how much are they underwater on unrealized loss. And at the moment, there's about $12 billion of unrealized losses in the staking pool. So if you compare that to the broader market here in blue, that's sitting down here at about 1,600. So there's quite a big difference between 2,300 and 1,600 in terms of the realized price and that cost basis. So really, the ability to actually sell and hedge and collateralize those staked ETH tokens, it does make sense why we've seen this explosion in momentum towards liquid staking derivatives, why Coinbase has launched theirs, because it gives people more options. So really, the explosion in growth of these particular services shouldn't really come as too much of a surprise, being that it solves these problems and it also allows investors to hedge and sell their risk. So just before we get started on the second dashboard, I just want to give you a quick update on what we've been doing over at Glassnode in terms of new content. And again, this is for our advanced and our professional members. So we have a new market pulse on forum. This one here, we actually built up and showed you step by step how we constructed a dashboard that can identify periods of tops and bottoms, essentially using a concept borrowed from drilling techniques. What we're looking for is when a huge portion of the market is entering into that profitability realm, and when we see correlations break down because either everybody is in profit, or we've seen at the top, or we've seen a transition in investor sentiment and behavior back towards that hodler status near bottoms. So really building up a dashboard, a workbench from first principles, using, interestingly, a concept borrowed from physics and the drilling world to construct these metrics. So a really, really interesting and fascinating study. And we've also recently released a series of workbench presets. So within those, we've got everything from market indicators, supply dynamics, proof of stake, pricing models, and we're building out these all the time. We're really rolling out quite a number of these new workbench presets, so do jump in to check those out. So moving into the second part of this video, and we are now going to focus on the supply dynamics. This is what a lot of people have been talking about with the drop in issuance from proof of work to proof of stake, and then also looking at the EIP 1559 burn. So we're going to start this analysis by looking at ETH supply. And we're looking at where are the large clusters of this supply, different categories of supply dynamics. So in the yellow here, we have the supply held on exchanges. In the red, we have the supply held in smart contracts. And up the top here, you can see that growing meaningfully, we have the supply held on the beacon chain. So you can see that the stake supply, it's not quite as large as smart contracts or as large as exchanges, but it is continuing to grow and becoming a significant proportion of the supply. I think we're over 12% of Ethereum supply is now in the beacon chain. So it shows just the magnitude of how much this is growing. And now that the merge has been de-risked to some extent, it is very, very likely we'll start to see this actually climb and continue to grow, especially with these liquid staking derivative tokens. It's likely we'll see this dynamic continue to play out. Now, stepping into some validator economics, looking at how does the issuance rate and the return for a validator differ based on how many people are participating. So in the Ethereum protocol, we have two calculations here. So the annual return on investment per validator. So essentially, if it's 4%, you're earning 4% in ETH on your 32 ETH deposit. That's what this is mapping out. And you can see here that we've actually got a formula that is dependent on the number of validators. So your ROI, the return on investment, actually declines the more validators enter the pool. And when you have a very large set of validators, we push above a million or even 1.2 million validators. Currently, we're about 430,000. So imagine a doubling or a tripling of the validator pool. This starts to stabilize. We're at 4.8% at the moment. This will start to stabilize closer to around 3 to 2.5%. Once we get to those large validator sets, this will continue to decline. So that return on investment does decrease. And simultaneously, the actual issuance, so the estimated annual issuance at the proof of stake layer, is also a function of validator count, except instead of being in the denominator where it decreases, so the return on investment goes down the more people are staking, the issuance actually goes up the more people are staking. So we can see that the overall annualized issuance continues to climb as more validators enter the network. So back when it was the Genesis block, we saw 155,000 ETH being minted per year on the proof of stake chain, and here we are at 671,000. So this will continue to increase as more validators enter the mix. So we can see that there's this interesting dynamic between validator count, and the higher that the yield is, the more validators start to come in, and that compresses down the yields. And in that way, we have this almost fluid bond-like mechanic where the more people are, the more demand there is for something, the lower the yield goes down. We can then also calculate the estimated nominal inflation rate. So this is not looking at the EIP 1559 burn. This is purely what is the issuance rate. So pretend that there was no burn, how much supply is being minted onto the market. And at the moment, we can see that this is 0.56%, which is much lower than the 4.3% thereabouts was for the proof of work issuance. So here is essentially that first idea about the supply decline. We've gone from over 4% issuance to down to 0.56%. But remember, this will climb as more validators enter the pool. And until the Shanghai fork, that can only go up. We can only have more validators come in, or it stagnates because we actually can't have that withdrawal as yet. So now adding on that next layer, we've got our nominal issuance here in blue, and this is the nominal issuance here in blue at the top. And you can see it's much smaller relative to the red area, which is the EIP 1559 burn. Now, what this model here is looking at is essentially a simulated reality, because remember that over the last couple of months until the merge, we had proof of work issuance, we had proof of stake issuance, and we had the EIP 1559 burn. We actually had two sources of issuance which need to be accounted for. So we're going to build up this model. So up here we have our proof of stake only issuance, no burn. Here we have that same curve, and then the red is the simulated 1559 burn. So let's imagine that the merge went live at the same time as EIP 1559 back here in August 2021. If that was the case, this purple curve shows you that we would have been in deflationary territory through most of the bull run. But remember, this doesn't factor in the proof of work issuance, which was happening at the same time. Now, even so, you can see here that the purple curve is now trading above the blue line. This is indicating that the burn is currently less than the proof of stake issuance. Even after the merge, we are currently in an inflationary regime. So it's just important to kind of map out these things and understand the real dynamics of what is going on. So at the moment, even post-merge, we are still in an inflationary ETH regime, but rather than it being 0.56%, the burn is essentially halving that, so it's 0.25%. So we've more or less halved it. The burn is taking up about 50% of the proof of stake issuance. So it's still obviously a massive decline from proof of work. It's about a 92% decline, so quite dramatic, but we are still in that inflationary regime. And this is primarily being driven by the low gas fees, by the way. We're seeing gas fees return to actually almost pre-2020 bull market levels. So very, very light congestion on the Ethereum chain at the moment, which is the primary reason why the burn is so small historically. So now we have a combined model. This proof of stake net supply chains, this is another one of these workbenches that we've recently released. So you will find this as a preset on Workbench. You can always access these charts from the dashboard, which is in the description below, and you can hit this little magnifying glass at the top here to actually view the full scale chart. So let's step through what this model is looking at. The orange curve here is proof of work. So imagine we only had proof of work with EIP 1559. And you can see it's much, much higher. And anything that's above this middle line is inflationary. Anything below it is deflationary. The blue curve is only proof of stake. So modeling this purple curve. So this blue curve is looking at the only proof of stake with EIP 1559. You can see the dramatic difference between these two. Now, the green curve is the actual reality. This is the fact of what actually happened for Ethereum because we have proof of work plus proof of stake issuance minus the burn. So this green curve you can see is actually higher than the proof of work issuance. And that is because there's an extra layer of proof of stake issuing on top of it. However, it has now collapsed down to the blue curve. So this blue curve is now the reality. Everything that's in the history is kind of a simulation, but post-merge, this purple curve and this blue curve, which are the same, is the real reality of how much coin is being issued on net. And we can see here that we're currently issuing about 871 ETH per day. During the proof of work phase or the actual reality phase, we were issuing closer to 13,000. So we're talking about 700 versus 13,000, a dramatic decline in daily issuance. You can kind of see the scale of that. And just to really close out, we're going to look at the very, very zoomed in. We're looking at the 1 hour chart here. This is the event of the merge. We have the proof of stake issuance here in green. We have the EIP 1559 burn in red. You can see that the green is larger than the red in scale, and that leads us to this blue curve, where you can see this initial deflationary period. There's about 12 hours of deflation post-merge, higher network congestion, lots of people trying to transact, be one of the first transactors post-merge, but we have since migrated back into an inflationary regime. Nevertheless, the actual supply distribution is about 92% lower than what it was during proof of work. So it gives you a bit of a sense of scale of just how significant the merge effect was. So thank you for tuning in for that. Hopefully you found that useful. Please let me know in the comments whether you enjoyed this type of content. It is a very, very new system. There are a lot more moving parts, but really on those dashboards, we've tried to document them and give you enough information to really digest and understand these tools and make them easy to actually deploy. So do let me know if you enjoy using those. Let me know if you have any comments or questions, and I will see you in the next one. Cheers.